Okay, so in this section, we are going to get back to the adjusting entries, and this time we're going to talk about the other side, the deferrals and reclassifications. Now, we're going to start over with the high-level summary, just in case you did not review the last section, and then we're going to dig into deferrals and reclassifications. So again, with the accounting cycle, we are at the adjustments journalized step. We're going to do journal entries for the adjusting entries. As an overview, these adjusting entries occur at the end of the accounting period. It could be a month, quarter, or a year. They're going to be completed before we do the financial statements because the goal is for all of our accounts to be proper. On the income statement, on the balance sheet, we want the balances to be good so we can have accurate financial statements. These adjusting entries are all about correcting for any timing differences between the accrual basis of accounting and the cash basis of accounting. In other words, did we receive cash before we could record it as revenue, or did we earn revenue before we received the cash? We want to correct for these differences. We want it to be under the accrual basis of accounting. So we have a summary of the two major types. The accruals, first of all, this is where the first thing that happens is the adjusting entry. We need to record revenue or expense before the cash changes hands. Before we receive the cash, before we pay the cash, recognition of revenue or expense comes first. The cash transaction comes in later. So the initial entry in this situation is going to be the adjusting journal entry. The subsequent entry later on in the next period is going to be the cash entry. If we move to the other side, which is the focus of this discussion, the reclassifications or deferrals. Revenue or expense is going to be recognized after the cash receipt or payment. In other words, the cash comes first. We receive the cash, we pay the cash, that's first, and then later on we can recognize either revenue or expense. So the initial entry in this situation is going to be the cash entry. It could be at any time throughout the year, throughout the period. The subsequent entry is going to be the adjusting journal entry that adjusts revenues or expenses to their proper balance. A reminder of the various rules for adjusting entries. We're always going to have at least a revenue or expense. It could be either. We have to have one of those two. And on the other part of the transaction, we have to have at least an asset or a liability. We can possibly have two assets, two liabilities, but we have to have at least one of them. For the adjusting entry itself, you will never see cash for these core adjusting entries. The cash entry would be something else. It's not the adjusting entry. It's either the one that exists before the adjusting entry or after the adjusting entry, depending on whether we're talking about a reclassification or an accrual. So now we're going to start talking about the deferrals or reclassifications. By the way, let's talk about that term specifically, deferral. What we're saying here is that yes, we've, in this case, paid cash, but we're deferring the recognition of an expense until later when we've actually incurred it. The reclassification, let's talk about that term. We're going to report something as an asset first, and we'll see the examples in a bit, but then we're going to reclassify it later to an expense when we've actually used it. That's where the terms deferral or reclassification come into play. So a deferred expense. Sometimes in this example we have a prepaid expense. This is probably the most common entry you'll have for adjusting entries. It could include things like prepaid rent, prepaid advertising, supplies, depreciation when we have fixed assets. What we're basically saying is we bought something or we prepaid for something in advance. We paid cash, but it's not an expense yet until we use whatever we paid for. So in this first example, we'll take prepaid rent. We prepay 1 year of rent in December of 2016, let's say, $12,000. It's $1,000 a month. So we have to record something right away. Even though it's not an expense yet, we have to record something. So we're going to debit an asset known as prepaid rent for $12,000 in this case. And the credit to cash, because we actually paid it, would be $12,000. My apologies for the typos here with the numbers. It'd be $12,000. So now later on, when we actually use up the rent, so keep in mind that first entry was the cash entry. Now we're at the end of a period, and we've used up 1 month's worth of rent, $1,000. So the entry here is to debit rent expense for $1,000 and to credit prepaid rent. We're using up that asset. We're reducing the asset with a credit for $1,000. So I like to think of these prepaids as us spending money to buy a coupon of monthly tickets, let's say. In most cases, you don't do this, but let's just visualize it this way. You pay your landlord for 12 months worth of rent up front. They give you a coupon book of 12 tickets. And then you can send in a ticket every time the month goes by instead of sending in more cash. That's just a way to visualize it. Now, in the next year, we would record the remaining 11 months. Keep in mind, this year we only had 1 month, December, so it's only $1,000. Next year, we use up the remaining 11 months, so it'll be $11,000. Let's look at the supplies example now. We prepay for these supplies. We buy them in advance, but we don't use them right away. So we're buying $5,000 worth of supplies in December, and at the end of the period, we have a remaining balance of $3,500. Apparently, we used $1,500 of supplies, assuming we had no beginning balance. So that's what we have to do. When you see these types of situations, you have to know, you usually start with your beginning balance. In this case, it's 0. Plus, what did we purchase? $5,000. Subtract out what you have left, $3,500, and that tells you what you used, $1,500. So our journal entry here would be when we first purchased the supplies is a debit to supplies. This is an asset. This is not supplies expense. This is the asset first. It's a resource we have. We debit supplies for $5,000. We credit cash for $5,000 to reduce the cash because we're using it up. And then at the end of the period, we would debit supplies expense to show that we've used the supplies. We debit the expense and we credit supplies. Now let's take a look at another type of prepaid where we have depreciation. In this case, we bought $500,000, some asset worth $500,000. We're going to be using it for 10 years. And for simplicity, since we haven't really talked about this yet, we're going to depreciate this asset over 10 years based on $50,000 per year. So first of all, we have to record the purchase of the asset. Here we are debiting a fixed asset for $500,000 to increase it. We're crediting cash because we spent it. Credit cash for $500,000 right off the bat. So we've increased the asset, decreased the cash asset. Now this one is a little tricky because depreciation expense is handled differently than most of our other assets. We still debit depreciation expense for $50,000 to increase that expense to show that we've used the asset, but we do not credit the asset directly. Instead, we credit an account known as accumulated depreciation, which we'll see in later chapters. But this accumulated depreciation that we are crediting, by crediting that account, it's a contra asset, which means it's the opposite of an asset. So it has the opposite normal balance. It has a normal credit balance. So as we credit this accumulated depreciation, we are actually increasing that account. Now, what it does is this accumulated depreciation offsets the asset's value on the balance sheet. So again, this will come up in later chapters. Here we're just briefly talking about the adjusting entry. For the depreciation, you're always going to have a credit to accumulated depreciation. It indirectly decreases the assets. So here we have deferred revenues, sometimes referred to as unearned revenues. In these situations, we've collected a lot of money in advance, but we can't count it as revenue yet. So instead, we just have to record it as cash, and it's going to be a liability because we owe something to the customer until we provide whatever service. Early collection of rent, early collection of insurance, these are all examples. So let's take a situation where we are a landlord and we collect 1 year of rent in advance in December of whatever year, $12,000, $1,000 per month. So in this case, so let's take a look at an example of a deferred expense, also known as a prepaid expense. Some examples here would be prepaid rent, prepaid advertising, supplies, because we're prepaying for supplies, we're buying them in advance of their use, and then a special type of prepaid known as depreciation. I'm going to briefly talk about that as well. In this example, a company prepays 1 year of rent in December of 2000, let's just say 16, for $12,000. So let's record the entry to reflect the initial payment of the rent in this December of 2016 for $12,000. So we are debiting prepaid rent, which is an asset, to increase it. It's almost like if you want to visualize buying a ticket book of 12 monthly rent tickets. And then as the months go by, you can just turn those tickets in. Just visualize it that way. And then we have a credit to cash for $12,000 to reduce that asset. Now, the end of the first month or the end of the first year is here, 2016 in my example. We used up December's rent. It was just 1 month, so we have to record a debit to rent expense for $1,000 because we've used it. We have to incur the expense, and we credit prepaid rent, the asset, to reduce that. The next year, let's say 2017, we have 11 months left that we used up, so we would debit rent expense for $11,000 and credit prepaid rent for the remaining $11,000. Let's take a look at another prepaid expense, supplies. So in this case, the company bought $5,000 of supplies in their first year, 2016, December. We had a zero beginning balance because they don't tell us otherwise. At the end of the period, they have a remaining balance of $3,500. This tells us we must have used up $1,500. 5,000 minus 3,500 is 1,500 that we had to have used up. So our first entry here is going to be to record the purchase of the supplies. Here we debit supplies, the asset, for $5,000. We credit cash for $5,000 because we used up the cash. And then at the end of the period, so here now we're on to the end of the period, we have to record the actual incurrence of the expense to show what we've used up. So we would debit supplies expense for $1,500, credit supplies for $1,500, and we're good to go. We've increased the expense, we've decreased the supplies asset. Now we're moving on to a special type of prepaid expense dealing with the purchase of a long-term fixed asset. In this example, the company buys $500,000, some asset, maybe equipment or a building. They buy it this year. It's going to be used up for 10 years, and it will be depreciated at $50,000 per year. The first journal entry is going to be to record the actual purchase of the asset. So we would debit the fixed asset for $500,000, credit cash for $500,000 to show that we're using it up to reduce it. Now the journal entry here for depreciation is a little bit different than the supplies journal entry. Yes, we are still debiting an expense, in this case depreciation expense for that asset, $50,000, but the credit in this journal entry does not go to the asset itself. Instead, it goes to what is known as a contra asset. A contra asset just means it offsets the asset. Think of contra as opposite or offset. It's an opposite of the asset, so it has the opposite normal balance. The asset has a normal debit balance. This contra asset, known as accumulated depreciation, has a normal credit balance. So we're crediting this account to increase it. We're crediting accumulated depreciation to increase this. What it does, as we'll see in the next slide, is it offsets the balance of the asset. So this is an indirect way of reducing the asset. So on the balance sheet, we would have the fixed asset listed at $500,000, less accumulated depreciation of $50,000, tells us what the net book value of that fixed asset really is, $450,000. We'll talk more about depreciation in later sections, but for now, this at least gives you an overview and explains that this is an adjusting entry. So now let's talk about deferred revenues. Here we have a situation where we received money in advance of when we actually earned it. So early collection of rent, early collection of insurance. Here we are on the receiving side. We are a landlord. We've collected 1 year of rent in advance, $12,000. So the first journal entry here is to record the collection of the rent. We have to debit cash for $12,000 to increase the cash, and we credit unearned revenue, which is a liability, for $12,000. By increasing this liability, we're basically saying that we owe our customer something. We either owe them the service or we owe them their cash back if we can't provide the service. Now the adjusting journal entry here to reflect how much we have actually earned. In this first year, we only have 1 month, December. So that would be $1,000. We would debit unearned revenue to decrease that liability, and we would credit rent revenue for the same $1,000 to show that we've now earned the revenue. In the following month, or the following year, we would have 11 months left that we have to record. So we would debit the unearned revenue for $11,000 to decrease it again, and we would credit rent revenue for that remaining $11,000. So this wraps up our discussion of adjusting journal entries, and we'll move on to the next topic of closing entries in the next session.